Shasi Rajan, and today we'll be discussing about income tax for NRI. In this video, we'll be discussing income tax provisions affecting NRI and how to plan your taxes well. If you're a non-resident Indian, then this video is important for you, so make sure you watch this video. As far as the NRIs are concerned, the income tax works for them differently apart from the residents. We have already discussed about residential status and its determination in detail in our previous video. The link to that will be given in the description box below. So if you have any doubt and want to know more about residential status, you can watch the video and find out. The basic rule of taxability of a particular income is that if you are a resident individual, your global income, that is your income generated all around the world, shall be taxable in India. And in the case of non-resident, the income generated in India only shall be taxable in India. Salary received in India, rent received from property in India, capital gains on the transfer of assets that is situated in India, interest income from the normal Indian bank accounts, etc. are some of the income generated in India, and they shall be taxable in the hands of an NRI. Now let us discuss why it is important for an NRI to file income tax return mandatorily. Most of the payments to NRI, such as the interest and rent payment, are liable for a tax deduction at the source at the rate of 30%, which is the highest rate of TDS prevailing in the country. To claim this refund of that amount, the ITR is to be filed mandatorily. Let us now look at this issue with the help of an example. Suppose John is an NRI settled in UAE. He has a normal fixed deposit in the State Bank of India, fetching an interest of Rs 2 lakh. Out of this interest of Rs 2 lakh, Rs 60,000 will be deducted by the bank in the name of tax and is deposited with the income tax department. And the balance amount of Rs 1,40,000 only will be credited in your bank account. To claim the balance of Rs 60,000, you will need to file an income tax return within the due date that is specified. Now that's just a tip of an iceberg relating to NRI taxation in India. There are more in store for you relating for NRI. However, we can discuss them later in another video. Now let us quickly rush into double taxation aspects of single income for an NRI and the reliefs that are available. Let's start with another example. Suppose Pooja is an NRI having income from royalties taxable in India. She's residing in a country where tax is chargeable based on residential status and any income generated from any part of the world is taxable. In that case, the royalties are taxed in India as well as the country of residence, resulting in double taxation of the same income, which is grossly unfair. Now, what is the solution here? Well, there are provisions in income tax that provide relief for such instances of double taxation. Countries often enter treaties that provide double taxation avoidance to remove genuine difficulties of taxpayers. These treaties are otherwise known as Double Taxation Avoidance Agreements, aka DTAA. If there is DTAA between two countries, the provisions of DTAA will prevail over the Income Tax Act and the income will be charged to tax in one country as per the rates prescribed in the DTAA. In our example, suppose the DTAA is prevailing between India and Pooja's country of residence. As per the DTAA, the income from royalties are to be taxed in India at the rate of 20% irrespective of the country of residence of an individual. Then, the royalty income of Pooja is liable to tax at the rate of 20% only. The benefit of DTAA can be availed either by exception method or by tax relief method. In our example, Pooja can either choose the exception method, wherein the royalty income from India is exempted from tax in the country of residence, or she can include the income of both countries and claim the relief of tax paid in the country of residence. But there is another problem there. The DTAA is not there between India and all other countries. In that case, there is a unilateral exception available where the taxes paid in one country can be claimed as a credit in another country and double taxation is avoided. Taxpayers, especially NRIs, need to have a basic understanding of these provisions for proper tax planning and take advantage of taxes paid in other countries. I hope I was able to shed some light on your queries. I'll see you on the next video. Till then, bye.